Okay, welcome again. So I want to look at leverage ETFs and at shorting trading strategies of leverage ETFs for the reason that we have established the fact that leveraged ETFs suffer from a compounding decay or might suffer from compounding decay. And also leverage ETFs, or maybe ETFs in general, do a rather poor job at delivering the daily returns they promise from the underlying index. Both 1 and 2, so both of these reasons affect the leverage ETF's performance negatively, especially in volatile markets. Now the question is, of course, can we make money on this? And the idea to do so is to short the leverage ETF because they perform worse over time, and hedge it with a position in the unleveraged ETF. So for one strategy could be to short the SSO, the 2x SPX, and long the SPY. Or another strategy could be to short the 3x UPRO and to long the SPY. Again, we're getting data from Yahoo Finance, and we're calculating the returns and we're calculating the strategy. So the strategy is you're going short the SSO and you're long two parts of the SPY to hedge it. So you have a neutral position without any market exposure, hopefully. You have the, we put it in long format, and we put it in a chart over time, and indeed you see we have the SPY, we have the SSO that outperforms the market, and you have in blue the strategy, which looks very boring, but indeed it is upward pointing over time, with basically close to zero volatility. And this can be seen here. We see the performance, the annual return, and of course the SPY you got a 12.4%, SSO 22.8%, and the strategy got you 2.8%, which isn't great if you're just looking at annual return, the total return. However, if you adjust it by the risk, by the volatility, at a volatility of 0.4, you get a Sharpe ratio calculated with zero risk-free rate of 0.66, which is higher than the SPY Sharpe ratio of 0.6. So yeah, indeed, this strategy was positive performing over time as compared to the SPY and SSO. Similarly, if we're doing the tree, this should be the tree. In the tree, 3x SPY, you have to balance out, hedge out the UPRO position, the short UPRO, by holding 3 times the SPY. Then we're going for this, yeah, correct. And we see again we have the strategy that is performing positively. Why would it be strategy tree? You have an upward trending return of the strategy. If you calculate the performance metrics again, you see that the Sharpe ratio is above 1. It has to be noted that this is since 2009 because that's when the UPRO got available. So yes, indeed, the strategy was performing positively. What are the key takeaways? The strategy to exploit the ETF performance lag does indeed look promising on paper. We also see that, especially here, we saw that this, especially during volatile times or market turbulence, we see that the strategy had little jumps upwards, which means that the strategy is favored by performance in a market with a lot of volatility. And also, of course, this is just one example. There's other ways to play out the strategy. For example, we could go short, also including the inverse leveraged ETFs. We could go short both the SSO and I believe it's SSH, the 2 times short S&P 500. Not 100% sure, but there's a big but. It's not so easy in reality. The reason is that rebalancing costs you money, so you have to rebalance on a daily level, on a daily frequency, and most of all, it's the cost of shorting that will hurt performance. Probably I will do another analysis to check the shorting fees of such a strategy. So if you want a code, it's all in the description. Thanks for watching and goodbye.